What's up, guys? It's Ryan from I Teach Credit. As you know, this is my card. This is my dream. The fastest way to this dream is by educating people like you on credit. Today, I want to talk about somebody had called me and they wanted to pay off their truck and they were also paying down some credit cards. And they asked me how that was going to impact their credit. And here's what happens, guys. If you pay off your auto loan, that is going to close that account. The closed account is going to cause your score to drop. I know you think that paying off an auto loan would actually cause your score to go up. Actually, the opposite happens. You lose more on-time payment history. That's one less open active account, and you lose some of that account diversification. Paying down a credit card, on the other hand, or paying that to zero will actually help boost your credit score because that directly impacts your credit utilization factor. Okay? So paying the credit card off or down to zero will boost your credit score because it's lowering the utilization factor. Paying off the auto loan is going to actually lower your score because you're going to have one less open active account with the diversification as well as the payment history. All right? Any questions on that? Let me know. Put some comments below. The same actually applies to a mortgage. If you pay off your mortgage, you would think, hey, I'm responsible. I should get more points. Unfortunately, the credit system doesn't work that way. It's not set up that way. You will actually lose a couple points. But it's okay. As long as you build a nice, thick credit profile, you'll still have nice high scores. Anything over 750, you're pretty much golden. All right? Any questions, let me know. Otherwise, I'll catch up with you in the next video.